Hey everybody, in this video we're talking about the crowding out effect. We're talking about how bigger deficits by the government cause interest rates to go up, causing businesses to invest less. That's right. The crowding out effect is when government deficits and their borrowing needs because of their deficits lead to higher interest rates and therefore business investment going down. Basically, the government deficits and their higher interest rates are crowding businesses out of the financial market, out of the loanable funds market. That's the crowding out effect. So what we want to do is we want to do it graphically. We want to deeply understand the graph, and to deeply understand the graph, I've got this thing above it, okay? And what am I going to do here? What am I doing here? Here's the thing, guys. The way that teachers out there do these bigger deficits, when governments run bigger deficits on the loanable funds market, and that's what's going to go here is the loanable funds market, is different. Some teachers, when the deficit gets bigger, they take that supply of loanable funds and they shift it off to the left, okay? Perfectly fine way to do that, and I want you to fully understand why they do it that way. Other teachers, like myself, we take the demand for loanable funds and we shift it off to the right, okay? So again, in both situations, you're going to get a higher interest rate, okay? One is to take the supply of loanable funds, shift it to the left. The other one is the demand for loanable funds and shift it to the right. For us to understand that, that's where I've got this visual. Now, it says financial market. I want you to basically think loanable funds market. This is the loanable funds market, i.e. it's the financial market. For all intents and purposes, we use the two terms interchangeably in a first-year macro course, okay? Loanable funds market, loanable funds market, financial market. Now, what is happening in this loanable funds / financial market is we have, I've got it erased here. Let me get it up to speed. Household savings funding business investment. See if I get that out of my mouth, right? Household savings is funding business investment. This is the two biggest flows that we want to associate that loanable funds market. If you didn't know that, that's something to take away from this video, guys, is the number one inflow is household savings, okay? The number one outflow or demand is business investment. So you were looking at how savings funds business investment. But we have two other actors that interact in the financial market, the rest of the world and the government. Now I'm going to start off talking about the rest of the world because I think it's going to inform us on how we handle the government. So let's start off with the rest of the world, okay? So domestic households, what they sometimes do is they go to foreign loanable funds markets, right? They take their household savings and they take it abroad. Well, this is called a capital outflow. I hope that makes sense, okay? When domestic households take their loanable funds to foreign loanable funds market instead of their own, and they don't make it available for businesses, that's a capital outflow. And how are we going to handle a capital outflow? Pretty much all teachers are the same. We're going to take that supply of loanable funds and we're going to shift it to the left, right? And hopefully that totally makes sense. If household savings is the supply of loanable funds, then when they take their household savings abroad, instead of keeping it here domestically, the supply of loanable funds in the domestic loanable funds market is shifting off to the left. Now, what also can happen is foreign households can bring their savings into the domestic loanable funds market. Well, that's a capital inflow. That's augmenting or adding to domestic household savings, right? This is an additional supply of loanable funds for business investment. What are we going to do with that supply of loanable funds? We're going to shift it to the right. Pretty much all teachers handle this one the same. Now we've got the government and the government deficit, right? The governments are borrowing, this is what it's showing, because of the deficit. Now, one way to think about government borrowing because of the deficit is that it's simply an addition, okay? An additional demand for loanable funds, right? This is a demand for loanable funds, money going out. This is an additional demand for loanable funds. They are borrowing money. They're demanding loanable funds to fund their deficit. So what we can say is this and this together give us the demand for loanable funds. That's one way to handle it. Again, that's how I handle it in my classroom. But the other way that you could see this deficit is you can see it kind of like this foreign loanable funds market, this capital outflow is what it is it's siphoning away savings, okay, domestic savings and really foreign savings, both, okay, so some of this could actually go that way too. But anyhow, it's siphoning away savings from business investment. So you can say, hey, if the deficit gets bigger, the supply of loanable funds is going to shift to the left. Let me recap very quickly. One way to say, okay, how am I going to handle government deficits? Okay, remember, I'm just going to put a D for deficits. Is we can say, hey, That's a demander of loanable funds. That's a demander for loanable funds. Certainly, the government is demanding loanable funds to finance their deficit, and we're going to associate both of these with the demand for loanable funds. Deficit gets bigger. Let's shift the demand for loanable funds to the right, okay? Another way to say it is, hey, really what this is it's taking savings away from business investment. So if we're taking savings away from business investment, we could take the supply of loanable funds and shift it to the left. Okay, let's go through both of these in our graph, okay? So I'm going to start off with my way, okay? So my way, and mine's kind of a little funky demand for loanable funds curve, okay, is I say, look, we've got businesses, but we've also got governments. They're demanders of loanable funds too. This little vertical portion right here, that is the deficit. And I like to make it vertical to emphasize, guys, governments are borrowing because of their deficit. They don't care what the real interest rate is. I mean, they do care. They want the interest rate to be lower, but they're going to borrow whatever they have to borrow based on their deficit, okay? The amount they borrow is based on the deficit, not the real interest rate. Sure, they'd love for it to be lower, but the amount they're going to borrow is going to be this amount regardless of what the real interest rate is. Businesses, that's this portion of the demand, okay? I've kind of like added them on to the government's demand for loanable funds. They are certainly sensitive to the real interest rate, all right? Now we've got the supply of loanable funds, right? We think of this as households, I like to say households domestic, it's households foreign. Okay, let's get a bigger deficit now. So we get a bigger deficit, to me, fairly straightforward, right? Going to increase the size of that deficit. So right there. Now, what we're going to do is we're going to kind of dig into this graph a little bit. So let me kind of do a few things I didn't do right off the bat. Let me put that original interest rate back in there, okay? Now, that right there is the increase in the size of the deficit, okay? This horizontal distance, that's how much the deficit increased, okay? Now, this demand curve, hopefully we understand, it's gone now. This is our new demand curve. At existing interest rates, the quantity supplied of loanable funds is less than the quantity demanded of loanable funds. We have a shortage of loanable funds. What happens when you have a shortage of anything? The price of that thing begins to go up. Now, as the price goes up, interesting is households, both foreign and domestic, are going to increase their savings in this loanable funds market, okay? You can see that right there. They're responding to the higher interest rate. But also, businesses are going to borrow less. That's right. This right here, that portion, that is the crowding out effect. That is businesses borrowing less. Now, what is the overall takeaway, okay? Well, we had this much saving, okay, and this much borrowing, okay? So that's how much borrowing and saving was happening, okay? At the end of this whole thing, we're going to have more borrowing and more savings. More borrowing and more savings. Now, don't get me wrong, okay? Governments increased their borrowing by that amount, okay? So governments are borrowing that much more, but businesses are borrowing less. They're borrowing that much less, but since governments are borrowing this much more, businesses this much less, we are borrowing more in total. Okay, debt, okay, as far as the economy-wide is concerned, debt is increasing. There is more borrowing happening. Again, that right there is the crowding out effect. Now, let's go to the other way that you can handle bigger deficits, okay? Another way to handle bigger deficits, see if I can get this up to speed real quick, is just to say, look, the demand curve, the demand for loanable funds, it's representing one thing, okay? I think teachers who go the route I'm about to go are saying, look, business investment is really important. So I want one curve just representing business investment. That's it, nothing else, okay? Let's keep that curve pure. And then you've got the supply of loanable funds, and everything else that happens is going to affect that supply of loanable funds. Now, if that deficit gets bigger, again, siphoning away that household savings, I think it's pretty straightforward, right? Deficit gets bigger, household savings is going that way versus here. There's going to be less supply of loanable funds available for businesses. So we take that supply curve and we shift it to the left, loanable funds, 0, 1, okay? Put our new dot in our new dot, okay? Put that over here. That was my original interest rate, okay? This right here, from this dot to this dot, that was how much bigger the deficit got. So the deficit got this much bigger right there. Okay, this curve is of course gone. At the original interest rate, quantity supplied, quantity demanded, shortage, just like we had before. And again, just like we had before, the interest rate starts going up. And just like we said before, the impact of that interest rate going up, but here's where it gets a little bit confusing, okay? And this is one of the reasons I don't love this approach, is domestic households and foreign households are actually going to begin to save more. We're actually seeing that bigger deficit as a reduction in what we say is total savings in the economy, which is this concept of national savings, which includes what the government is doing, which I think is a bit confusing, but it's okay. You can understand it that way, and there's identities that we can draw out and show all of this, okay? But I do want you to know that households and both domestic and foreign are going to save some more, okay, when this happens. This was really the deficit, which we're saying is impacting this particular curve. But then I think one of the good things about doing it this way is this right here, okay? It is clean. You can see that crowding out effect, super clean, okay? This is businesses borrowing less. And now we draw this down. This, okay, was our savings and our business borrowing, the amount of savings that was funding business borrowing, okay? Now, this is the amount of savings that is funding business borrowing today. Businesses borrowing went down, crowding out effect, super easy to see. Needs a little bit more of an explanation because actually household savings, domestic households and foreign households are actually saving more, okay? Even though it looks like saving is less because we have to deduct that deficit from it. Again, I think that's the confusing part, and that's one of why we don't do it here at Econ Busters. But I do think one of the things that's really good about doing it this way is how easy it is to see what's happening to business investment. And if you really want to focus on business investment and you just want to make that demand curve business investment, you can see that crowding out effect so perfectly clear. And it does make sense, right? I mean, hey, if a capital outflow is a reduction in the supply of loanable funds, hey, I could see that government deficit as also a siphoning away of domestic household savings away from business investment. It also works. I hope that makes sense to you. Two ways to do the crowding out effect. I hope you got the big parts of the crowding out effect, right? It's pretty doggone straightforward. Bigger deficit is going to cause the interest rate to go up, regardless of the way that you do it. The interest rate's going to go up, and when that interest rate goes up, regardless of the way you do it, business investment's going to go down. Bigger deficits lead to higher interest rates, lead to less business investment. That's a big one, and that is the crowding out effect. I hope that makes sense to you. Hope to see you in the next video.